President Biden just released the fiscal year 2025 budget proposal in the amount of $7.3 trillion and his plan to cut the deficit by $3 trillion over the next 10 years by taxing wealthy people making over $400,000 a year, corporations, millionaires, and billionaires. But this one especially got my attention because some of his proposals are going to make a big impact on people like you and me who are actively trying to achieve financial independence and retire early, and not just for the people making over $400,000 a year or corporations. And just so you know, I don't make $400,000 a year. Not to mention, he proposed several tax changes in 2025, which include doubling the capital gains tax rate to almost 50%, removing the Backdoor Roth IRA, taxing unrealized gains, removing step-up cost basis, removing 1031 exchange for real estate, and increasing the Medicare tax rate. He didn't mention anything about reduced spending. And I want you to be the judge of this proposal. And let me know in the comment section down below what your thoughts are on his budget proposal. Let me be transparent with you. And I am not a fan of these changes because they're not just targeting wealthy people, they're targeting middle class households as well. They're just not saying it. And I'm going to explain why. With that said, let's get right into it. The first thing the White House is trying to get rid of is the backdoor Roth IRA conversions. And they have been trying to get rid of this rule every year since Biden took office in 2021. And they failed to pass this with Secure Act 2.0 in 2022. And let me explain why this is targeting people making less than $400,000 a year. The White House is saying that this is targeting multimillionaires, but in reality, the backdoor Roth IRA conversion benefits people who make over $146,000 a year as single individuals or $240,000 a year for married couples filing their taxes jointly. If your income exceeds those numbers I just gave you, you cannot contribute directly to the Roth IRA or transfer money directly from your checking account to your Roth IRA. The backdoor Roth IRA that Biden is trying to get rid of exists to allow people making over $146,000 a year to transfer their money from their checking account to their traditional IRA here as a non-deductible contribution in after-tax dollars. And then they can transfer these after-tax dollars into the Roth IRA. And then you won't even have to pay any additional taxes on the conversion because you already pay taxes on the traditional IRA non-deductible contributions. The government can't tax you twice on your retirement. So when you file your tax form 8606, indicating that the money you put into your traditional IRA is in fact in after-tax dollars, you're showing the IRS that $7,000, which is the maximum contribution limit for the year 2024, is in after-tax dollars. And I coach my clients about the Roth IRA. So if you're interested in joining my private client program to achieve financial independence, you can schedule a free consultation with me by visiting firesightshow.com/coaching. In my honest opinion, this is a stupid rule to take away because the contribution limit is already low at $7,000 for people under the age of 50 or $8,000 for people over the age of 50. And when you contribute or backdoor $7,000 in 2024, the earnings and interest that accrue out of that $7,000 are going to become tax-free when you turn 59 and a half. The Roth IRA was created in 1997 to allow American people to contribute after-tax dollars to their individual retirement accounts so that they can enjoy tax-free income when they turn 59 and a half. If they take away the backdoor Roth IRA option, it's going to make an impact on people making over $146,000 a year, not people making over $400,000 a year. And having the backdoor Roth IRA option is really crucial for retirement planning because retired people or people who fired want to reduce their tax liabilities as much as possible, right? The second proposal is to reform the capital gains tax. At the time I'm recording this video, the long-term capital gains tax rates are 0, 15, 20%, and an additional 3.8% in net investment income tax rate after the standard deduction. And if you take a look at the footnote here on page 80, of the 2025 budget proposal, the White House is proposing to increase the capital gains tax rate to 44.6%. And this is also going to increase the net investment income tax rate from 3.8% to 5% if your household income is above $400,000 a year. So that's a total of 49.6% just for capital gains. And keep in mind that if your income is $300,000 a year and you happen to sell a stock, mutual fund, or ETF with a net profit of $150,000, then that $50,000 out of the $150,000 is going to be taxed at 49, and I meant to put 49.6% in long-term capital gains if you held your security for at least a year. And trust me when I say that people will do everything possible not to exceed that income if they ever pass this law. And most people would rather give this to charity instead of giving it to the government. And they're going to stop selling their investments unless they can offset with capital losses. Instead, they're going to borrow against the assets because billionaires like Elon Musk do this all the time to reduce their tax liabilities. For example, if they have $10 million in taxable assets with a broker, then they can open up what's called a line of credit or securities-based lines of credit against the portfolio. And it's kind of similar to a HELOC when you borrow against a home, but in this case, it's against the stock portfolio. And borrowing against an asset doesn't incur taxes because the IRS doesn't treat debts as income. Also, it's much cheaper to borrow against the assets rather than sell assets and pay capital gains tax, right? And they might be paying, let's say, 8 to 12% in high interest debt. Well, we'll call that interest debt, but this is going to be variable interest rate, okay? And for that loan, let's say in 2024, but that is still cheaper than 49.6% from 8 to 12% in capital gains. The White House also stated that they want to close the so-called loophole to tax wealthy people on unrealized gains if they have income and assets that exceed $100 million. And this will not happen until the Supreme Court makes a decision in Moore versus United States. Moore argues that the 16th Amendment of the Constitution grants Congress the power to impose a federal income tax, but only on realized gains. If the Supreme Court rules against Moore, then Congress could tax people on unrealized gains in the future using this Supreme Court case. If you don't know what the difference is between realized gains and unrealized gains, I want you to log into your 401k, Roth IRA, or taxable brokerage account and click on unrealized gains. So for example, let's say you purchase an S&P 500 index fund for $100,000. And now you have 50K in earnings and interest, right? And that $50,000 is what the White House wants to tax the wealthy on. And you'll have realized gains if you sold the S&P 500 index fund from a year ago and you get taxed at 0, 15, or 20% of the gains, depending on your marginal tax rate. So you have to sell the investments now in order for you to pay the tax. But what the White House wants to do is if you have over $100 million in total assets making $400,000 a year, then they want to tax the unrealized gains, which is something that you haven't sold in the broker or whatever else it might be. Now, why does this matter to you if they just want to tax people making $400,000 a year or with assets over $100 million? In order to enforce this type of tax, the IRS would implement a very invasive process to have every American list their assets, including vehicles, jewelry, art, baseball cards, season tickets to a football stadium, or anything else that has pretty much value, right? And given the history of the IRS, this invasive process should be very concerning to the American people because taxpayers could be subject to a gross invasion of privacy. And you can bet that wealthy people will move their assets out of the US before this rule gets implemented. And that's if they ever get implemented, right? So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using a link in the description below. Speaking of income tax, Biden wants to repeal the Tax Cuts and Jobs Act that was passed in 2017, but only for the top marginal tax rate. And right now, the marginal tax rate for people making over $609,000 a year for single individuals or $731,000 for married couples is 37%. The White House wants to go back to the pre-2017 tax rates of 39.6% for people making over $400,000 a year. That was the direct quote from the White House press release. Now, here's a little bit of pickle, and I'm going to show you this real quick here because they mentioned $400,000 a year. And that to me, people in the 35% marginal tax rate will also be affected by the change because people making between $243,000 and $609,000 is already taxed at 35%. If the tax proposal passes, then they're most likely going to change the 32, 35, and 37% tax thresholds. So it's not just going to be for people in the 37% marginal tax rates at that point. The White House is also looking to increase Medicare tax from 3.8% to 5% for the people in the 37% marginal tax rate. And we already know that Medicare and Social Security are already in the hole right now. And I'm not sure how the government can solve this problem. More Americans are becoming reliant on social programs to survive their retirement. And the next one they want to get rid of is the stepped up cost basis. Let me go to page 79. This is going to matter more for almost everyone because this is a tax benefit that's been around for a while for people who pass away and pass their assets down to their heirs. So in other words, the government wants to get their capital gains tax when you pass away instead of your cost basis being stepped up. Let me read what the Treasury Department says about the step-up cost basis, and please don't shoot the messenger. Preferential tax rates on long-term capital gains and qualified dividends disproportionately benefit high-income taxpayers and provide many high-income taxpayers with a lower tax rate than many low and middle-income taxpayers. Preferential tax rates also disproportionately benefit white taxpayers who receive the overwhelming majority of the benefits of the reduced rates. If the new laws are adopted in 2025, then those capital gains will be taxed if it's not donated to charity. If you don't know what a step-up cost basis is, let me give you an example. Let's say I have $1 million invested in a mutual fund with a cost basis of $500,000. And then over the course of 20 years, it's accrued $500,000 in earnings and interest, right? So when I am alive and I sell this entire portfolio, then I will owe taxes on the $500,000 in earnings, right? But if I die today, and I'm sure many of you will be sad, but let's just say that gets passed down to my daughter, then the new cost basis for this mutual fund would be the fair market value at the time of my death, or $1 million right here in this example with no capital gains. So the new cost basis will be $1 million. If she sells the mutual fund, then she wouldn't have to pay any capital gains tax on it. And it's sort of like a life insurance policy because you wouldn't pay taxes on that either. And just keep in mind that the stepped up cost basis is for your heirs, which is typically defined as your children or grandchildren or adopted children. The state you're living in will determine who the heirs are. But some states will even allow you to do what's called a double stepped up cost basis when a married couple's assets are inherited by their beneficiaries after both spouses pass away. So let's say my wife and I own a property in the state of Nevada that we purchased for $300,000. If I pass away first and the fair market value for the house is, let's say, $500,000, then the first step up cost basis will become $500,000, or saving my daughter $200,000 in capital gains. If my wife passes away later, and if the house is worth now at $600,000 at the time of her passing, then there will be a second step up cost basis. Only some states have this tax benefit, so be sure to talk to your estate attorney about your double step up cost basis. But taking away step up cost basis will end up hurting millennials and Gen Z because they're the ones who are going to receive inheritance from most likely baby boomers or Gen X generations, right? Biden is also targeting real estate investing by proposing to remove the 1031 exchange. And if you don't know what a 1031 exchange is, without going too much in depth about it, it's when you sell your investment property and reinvest the proceeds into another similar real estate property. So if I sell this duplex for $400,000 and then use that money to buy another duplex, I won't have to pay capital gains tax on the proceeds of the sale of that duplex under a 1031 exchange. And here's what the White House said about the 1031 exchange. The budget closes the like-kind exchange loophole, a special tax subsidy for real estate. This loophole lets real estate investors, but not investors in any other asset, put off paying tax on profits from deals indefinitely as long as they keep investing in real estate. This amounts to an indefinite interest-free loan from the government, and real estate is the only asset that gets this sweetheart deal. And the 1031 exchange has been around for over 100 years to encourage real estate investment and market growth. And like everything I listed so far in this video, it's going to take an act of Congress to repeal these tax benefits and loopholes. The chances of any of this happening are really slim unless Congress votes on it. So we'll see what happens. I went through all of the documents about the budget proposal, but they never once mentioned how they're going to cut their spending next year or in the next 10 years. It's clear that they're targeting wealthy and high income earners to fund their spending. And when I do my budget, if my expenses exceed my income, I'm going to cut my expenses and then I'm going to increase my income. The government doesn't want to reduce spending, so they decided to target wealthy people instead because that's the easier narrative. And I know I sound like I'm defending wealthy people, but my common sense tells me that this is not just targeting wealthy people, but it could have a significant impact on middle-class families as well. Should we close some of the tax loopholes? Absolutely. But the core problem here is that the government has been spending more money than ever, and people are paying attention to this. If the government continues to borrow money or operate at a deficit, our tax dollars will eventually just go directly to the interest of the debt repayments. Let me know in the comment section down below about your thoughts on President Biden's budget proposal. And this has been another beast of a video, and I hope you got a lot out of it.